Welcome to the deep dive. Today, we're embarking on a journey to go, well, beyond the headlines, beyond just the big aggregate statistics you might hear about.
Yeah, we want to truly dig into what's really happening on the ground across the United States economy.
Exactly. And we're going to hear this story told really through the eyes of the actual businesses, community organizations, and individuals who are living and working in it every single day.
That's right. This isn't about, abstract economic models or just numbers on a chart, not primarily anyway.
hmm
We're aiming to get that boots on the ground perspective, seeing the real texture and nuance of economic activity district by district, sector by sector.
And our source material for this particular deep dive, it comes from I think, a unique and incredibly insightful report from the Federal Reserve System.
It really is. We're talking about the Fed's Beige book.
Right. The latest iteration, specifically the one from May 2025. Now, it's published 8 times a year, usually ahead of the big Federal Open Market Committee meetings.
The FOMC.
And while you might hear, a passing mention of its overall findings in the news, maybe a sentence or two, very few people actually get the chance to really immerse themselves in the richness and the detail of what's actually contained within its, well, virtual pages these days.
And that's exactly where we come in today. Our mission really is to take this May 2025 Beige book, and we're looking at both the national summary and the detailed reports from each of the 12 Federal Reserve districts,
Okay.
and distill the most important insights for you, our listener. We want you to walk away with a really comprehensive, nuanced understanding of the current state and the outlook of the economy across the country.
And to do that quickly and thoroughly, kind of cutting through the noise.
Precisely. And just for context, this specific report we're diving into today, it was prepared by the Federal Reserve Bank of St. Louis, and it reflects information that they collected on or before May 23rd, 2025.
Okay, so very recent data, relatively speaking. Before we actually dive into the findings themselves, let's spend a few minutes, maybe more than a few, really understanding what the Beige Book is and why it's such a valuable, maybe even unique piece of economic intelligence. We're drawing this directly from the About This Publication section in the source material itself. So maybe start us off. What exactly is the Beige Book at its core?
Okay, so at its heart, the Beige Book is the Federal Reserve System's own publication. It reports on current economic conditions, which is important, but also, crucially, the prospects for those conditions.
The outlook.
Yes, the outlook, and it does this across all 12 Federal Reserve districts. But what really makes it stand out, I think, is that it characterizes these regional economic conditions based on a variety of mostly qualitative information.
Mostly qualitative. So yeah, confirming it's not just charts and graphs of GDP growth or, unemployment figures then.
No, not primarily. It's gathered mainly through reports from the bank and branch directors within the Fed system, but also significantly through interviews that Reserve Bank staff conduct and online questionnaires completed by a really diverse range of sources.
And who are these sources?
Well, they include businesses of all sizes, community organizations, economists, market experts, and, various other contacts who have valuable insights into what's actually happening in their specific local or regional economy. It's about tapping into that ground level knowledge.
So it's really capturing the anecdotal evidence, right? The lived experience, the conversations happening on Main Street or maybe in corporate boardrooms, rather than just those big aggregated statistical trends we often see presented.
Exactly. It's the stories behind the numbers. And because this information is collected from such a wide range of contacts, and they use both formal methods like questionnaires and informal ones like interviews and ongoing relationships, the Beige Book serves a really critical role. The report itself says it complements other forms of regional information gathering the Fed undertakes. It provides that texture, the context, the color that pure quantitative data, might completely miss.
I see. So it helps paint the why behind the numbers. It gives context to the official statistics we see elsewhere. Now, since it comes from the Federal Reserve System, is this report meant to represent the official views or like the policy positions of the Fed's policymakers themselves?
That's a really important distinction, and the source material is absolutely crystal clear on this point. The Beige Book is not a commentary on the views of Federal Reserve officials.
Okay, good to know.
It is purely a summary of the information that the contacts, the people they talk to out in the economy, have reported to them. It basically allows the public and us today to see the kind of ground-level intelligence that helps inform policy discussions. But it absolutely does not dictate those policy discussions or represent an official stance.
Got it. So it's kind of like the raw, maybe slightly filtered, but essentially the direct feedback from the economy itself, not the Fed's interpretation or their policy position baked in.
That's a good way to think about it.
And how do they ensure they get a representative or objective view from these contacts? Is it just whoever picks up the phone?
No, definitely not. That's where the curation process comes in,
Yeah.
and they're very deliberate about this. The contacts providing this information are not selected at random.
Okay.
Instead, each of the 12 reserve banks actively strives to curate a diverse set of sources within their own district. They're specifically looking for contacts who they believe can provide accurate and objective information across a broad range of economic activities relevant to that region.
So they're targeting specific knowledge and perspective.
Right. This targeted approach helps ensure they're getting meaningful insights from people who are really deeply embedded in the economic landscape, who understand the nuances of their industry or their community. It's about quality insights over just sheer quantity from random sources.
That makes a lot of sense. They want people who actually know what they're talking about for their specific area. And then, okay, once all this qualitative information is gathered from the 12 districts, how is it actually used? Does it just become this public report we're reading, or does it serve a more direct purpose inside the Fed itself?
It definitely serves multiple purposes.
Right.
Primarily, as you might expect, the information gathered from these contacts supplements the quantitative data and the analysis that the Federal Reserve economists and staff use when they're assessing economic conditions in their own districts and nationally.
Okay, so it adds flavor to the hard data.
Exactly. And the qualitative nature of the report, this is where it's incredibly valuable internally because it creates a unique opportunity for them. It allows them to characterize dynamics, the underlying forces at play, and maybe even more importantly, to identify emerging trends in the economy, things that might not be readily apparent just by looking at the available economic data, which often comes with a lag anyway.
Ah, so it could be like an early warning system, perhaps, or at least a way to understand the forces that are driving the statistics we'll eventually see, maybe explaining why the numbers are moving the way they are.
Precisely. It helps them get ahead of the curve a little bit, or at least understand the why. And then, by bringing all 12 of these district reports together into the national summary section, it enables a direct comparison of economic conditions in different parts of the country.
Which must be super helpful.
Oh, absolutely. It's very helpful for assessing the overall national economic outlook, allowing the Fed staff and policymakers to see if trends they're observing are just localized phenomena happening in one or two places, or if they're more widespread across the nation. And the main purpose the report emphasizes is to characterize the change in economic conditions since the previous report. It gives that sense of momentum or shifts currently underway.
Okay, let me try and summarize that then. The Beige book. It's a snapshot, taken 8 times a year, based on direct, qualitative insights stories, really from a diverse network of businesses, community leaders, experts across all 12 Fed districts. It complements the traditional data. It helps identify emerging trends. It provides a comparative view across the country, explicitly does not represent the views of Fed officials themselves. And its main focus is characterizing the direction of travel since the last report. Did I get that about right?
Yeah, that's a fantastic and accurate summary of why this report is so insightful and why we think it's worth diving deep into. It really gives you, the listener, a sense of the kind of real-world conditions and perspectives that policymakers are considering when they make their decisions.
Okay, fantastic. That sets the stage beautifully for why we're doing this deep dive today. So for you, our listener, consider us your guides through this really detailed report. Our mission, as we said, is to help you cut through the noise, highlight the most important nuggets of knowledge and insight, and give you a rich, nuanced picture of the U.S. economy as it looked in May 2025, directly from the people actually experiencing it.
All right, let's dive in then, starting with the big picture, the national overview. The headline finding from this May 2025 Beige book is that reports across those 12 Federal Reserve districts indicate that overall economic activity has declined slightly since the previous report.
Declined slightly. Okay, that sounds like a fairly clear signal nationally, maybe a bit negative. But knowing the Beige book and its district-by-district nature, I'm guessing that national average probably hides a much more complex story on the ground, doesn't it?
It absolutely does. You're spot on. And the source material immediately provides that crucial nuance right after the headline. While the national picture averages out to a slight decline, the reality when you actually look across the country is, well, more like a mosaic.
Okay.
Only half of the districts, 6 out of the 12, actually reported slight to moderate declines in activity, which means, of course, that a full half of the country's districts were either stable or even saw some growth.
Okay, so breaking that down further, the report says 3 districts reported no change in economic activity compared to the last report, and another 3 districts actually reported slight growth. So yeah,
Yep.
definitely not a uniform contraction across the board. It's more a picture where maybe some regions are pulling back modestly while others are just holding steady or even inching forward a little bit.
That regional divergence is incredibly insightful right off the bat. It tells us that whatever economic forces are at play, they aren't hitting every single part of the country in exactly the same way or with the same intensity.
Yeah.
That national number, the slight decline, it's just an aggregate.
Yeah.
But the specific drivers, the pressures, maybe the local industry mix, or specific challenges like weather events, or even different exposures to policy changes, those are clearly having varied impacts depending on where you look.
Yeah, that makes sense. Speaking of things impacting everyone or maybe impacting everyone differently, was there any kind of overarching theme, something that really permeated all the district reports, regardless of whether their local activity was growing, stable, or declining, something that seemed to be a universal factor in May?
Yes, there absolutely was. And it's really a dominant thread that's woven through the entire report, from the national summary down to the individual district details. All districts, every single one, reported elevated levels of economic and policy uncertainty.
Yeah.
Every single one. This wasn't just, a minor footnote mentioned in a few places. It was described as a widespread, pervasive observation across the entire country.
Uncertainty. Gosh, that word feels unavoidable in almost any economic discussion lately. What did the contacts in the Beige Book reports actually say about the consequence of that elevated uncertainty? How is it actually impacting decision-making on the ground, according to the source material?
The report is quite explicit about the link here. It states that this elevated uncertainty has led directly to hesitancy and a cautious approach to business and household decisions.
Hesitancy and caution.
Yeah. Think about what that means in practice, right? If
Yeah.
you're a business owner and you're genuinely unsure about future demand for your products or what your input costs are going to be, or maybe what regulatory changes are coming down the pike, well, you might delay that new hire you were considering.
Right, you hold off.
You hold off. You might postpone investing in that new piece of machinery or put the brakes on plans to expand your facilities. It introduces friction into the decision-making process.
It's like trying to drive in a really thick fog, isn't it? You naturally slow down, maybe even stop completely, and you definitely hold back on making any big, irreversible commitments because you just can't see clearly what's ahead.
That's a perfect analogy. And that same caution applies to households, too, according to the report.
Hmm.
If you as an individual are uncertain about your job security or your future income potential or just the broader economic environment, you might rationally decide to put off buying a new car or delay a major home renovation project, or maybe just pull back on discretionary spending, eating out less, fewer vacations, things like that.
Mhm.
And when this kind of hesitancy becomes widespread, affecting millions of businesses and households all at the same time, it can act as a significant drag on overall economic activity. You can slow things down, even independently of other underlying factors. The uncertainty itself sort of becomes an economic force.
Huh. So the national picture we're getting is one of slight overall decline, maybe driven significantly by this widespread hesitancy that stems from elevated uncertainty. But underneath that national average, there are these notable regional pockets of stability or even slight growth. Within that context, what were some of the highlights across the key sectors nationally, just based on the summary section?
Okay, looking across the major sectors, the national summary mentioned that manufacturing activity declined slightly nationwide. So a bit of a drag there.
Okay.
Consumer spending reports were described as quite mixed. Most districts reported either slight declines or maybe no change in consumer spending levels compared to the previous period. However, there's a really interesting note that some districts reported increases in spending specifically on items expected to be affected by tariffs.
Ah, tariffs again. We're going to have to dive deep into that, it sounds like.
Oh, definitely. That detail is quite telling. It suggests a kind of behavioral response, maybe consumers trying to buy certain goods before anticipated price increases hit.
Yeah, front running the price hikes. Makes sense. What else?
Let's see. In real estate, residential sales were little changed nationally, so fairly stable overall. Reports on new home construction, though, largely indicated that activity was either flat or slowing down.
Okay, construction may be cooling a bit.
Seems like it. Reports on bank loan demand and also on business capital spending plans were described as mixed, which kind of aligns with that overall varied picture we're seeing across the country, some strength, some weakness.
Right, no clear trend there.
But interestingly, activity at ports may be connected to that potential forward buying ahead of tariffs was described as robust. Strong activity at the ports. Meanwhile, other transportation and warehouse activity was more mixed.
Okay, so a lot of cross-currents swirling around, but the dominant feeling being conveyed, it seems, is one of pervasive cautiousness, driven by that fundamental uncertainty. Given this snapshot of current conditions in May, what did the contacts report about their outlook for the economy going forward?
Nationally, the overall outlook was described as remaining slightly pessimistic and uncertain.
Okay, so no real change there from the last report.
Apparently unchanged relative to the previous Beige book report, indicating that that cloud of uncertainty hadn't really lifted by late May. However, here again, the district-level reports provide some really important nuance. The source explicitly notes that while the national outlook was stable but pessimistic, a few district reports indicated the outlook had actually deteriorated in their region,
Oh, getting worse in some places.
while a few others indicated the outlook had improved somewhat.
Huh. That's a significant divergence in sentiment about the future, isn't it? What might be causing some districts to feel like things are actually getting worse for them, while others are seeing signs of improvement, even amidst this national pessimism?
Yeah, it likely ties right back to those regional differences and specific exposures we talked about earlier. For example, a district that's heavily reliant on, say, manufacturing goods that are now facing retaliatory tariffs for export, they might naturally see their outlook deteriorate.
Yeah.
Or maybe a region where specific federal funding cuts, which we'll discuss later, have a really large impact on local organizations and projects, their outlook might worsen.
Makes sense.
Conversely, a district that's maybe benefiting from robust domestic demand in sectors that are less exposed to trade issues, or perhaps seeing a specific local industry really flourish for some reason, they might feel slightly more optimistic or at least less pessimistic, despite the broader national uncertainty.
So for you, the listener, this really reinforces that idea that while national averages are useful shorthand, the economic reality you actually experience day to day can be very different depending on where you live, what industry you work in, and what specific local factors are at play.
Exactly. It's not a monolithic economy.
Okay, that provides a really solid overview of the national picture and highlights the foundational role of uncertainty. Let's zoom in now on the labor market. That's always such a key indicator of economic health. What did the Beige Book contacts tell the Fed about employment and wages back in May?
All right, the labor market.
Mm.
The national summary states that employment has been little changed since the previous report.
Little change. Okay, so that suggests overall stability, at least in terms of the total number of people employed.
Yeah, in terms of headcount, pretty stable nationally. But, as usual with the Beige Book, the district reports give us the deeper, more textured story. Most districts did describe employment levels as basically flat in their region. However, digging deeper, 3 districts actually reported slight to modest increases in employment,
Okay, some hiring then.
while 2 districts reported slight declines. So yes, overall stability nationally, but definitely some pockets of hiring and some targeted reductions happening across the country. Not completely static.
Okay, little changed overall, but still some churn underneath. Were there any signs within these reports that the labor market, despite the stable headline number, might be shifting, maybe becoming less tight than it has been in recent years?
Yes, absolutely. The report includes several indicators that suggest a subtle but potentially important shift towards softening labor demand. For instance, many districts reported experiencing lower employee turnover rates.
Fewer people quitting.
Exactly. Fewer people voluntarily leaving their jobs. And alongside that, many districts also reported seeing more applicants for their open positions.
Okay, so easier to fill jobs when they do have openings.
Potentially, yes. These two things together, lower turnover and more applicants, are often seen as classic signals that the intense competition for workers, that very tight labor market we've talked about so much, might be easing somewhat. It could mean employees are feeling less confident about jumping to a new job for a big pay increase, or maybe finding fewer opportunities to do so, and employers are finding they have a slightly larger pool of candidates to choose from when they are hiring.
Right, lower turnover and more applicants. Those feel like pretty concrete. On-the-ground signs that the balance of power in the labor market might be shifting, maybe away from being so heavily in favor of employees towards something a bit more balanced, or maybe even starting to lean slightly towards employers in some areas or industries.
Exactly. And echoing that pervasive theme of uncertainty that we keep coming back to, comments about uncertainty delaying hiring were described as widespread across the districts.
Okay, so uncertainty is directly impacting hiring decisions too.
Explicitly, yes. Furthermore, all districts described experiencing lower labor demand compared to the previous reporting period. Contacts specifically cited things like declining hours worked and less overtime being offered,
Hmm.
hiring pauses being implemented, and even concrete plans for staff reductions as evidence of this lower demand.
So let me see if I understand this. Even if the total number of people employed hasn't changed dramatically nationwide, it's little changed. The intensity of the demand for labor seems to be clearly lower. Businesses are hitting the brakes on hiring because of that uncertainty, and some are even planning or actually implementing staff reductions. Is that a fair summary?
I think that's a very good way to put it. The overall number might be stable, but the underlying dynamics suggest a cooling trend. And while staff reduction plans and layoffs were definitely mentioned, the report is careful to point out that these were not pervasive nationally.
Ah, okay. That's an important distinction.
It is. It suggests that where layoffs are occurring, they seem to be more targeted adjustments within specific industries or perhaps specific companies that are facing particular pressures, maybe from tariffs, maybe from funding cuts, maybe just from slowing demand in their niche, rather than a broad wave of layoffs affecting the entire economy.
Do we have examples of those specific sectors?
Yeah, the source material gives some. For instance, the Chicago Fed noted that while employment rose modestly overall in their district, contacts and heavy truck manufacturing specifically mentioned that all the original equipment manufacturers, the OEMs, had announced layoffs.
Wow, okay. Industry specific.
Very. The Dallas Fed mentioned layoffs occurring in the retail sector and also that energy firms were planning workforce reductions. The Boston Fed cited layoffs happening in the government sector. And Philadelphia reported some food industry firms were experiencing layoffs, which they linked partly to supply chain issues. So it's definitely happening, but it seems to be concentrated in specific corners of the economy rather than being a widespread phenomenon at this point.
That nuance is really important. It sounds like maybe surgical adjustments in troubled spots rather than deep across the board cuts everywhere. Were hiring plans completely frozen everywhere else then, or were there exceptions to that cautious approach?
Not completely frozen everywhere, no. Interestingly, the report mentions that two districts specifically noted that for many of their contacts, hiring plans had not changed since the start of the year.
Oh, so some businesses were sticking to their plans.
Apparently so. The St. Louis Fed reported that most of their contacts indicated their staffing plans remained unchanged from what they had intended earlier. And the Kansas City Fed noted that a slim majority of their contacts reported unchanged hiring plans. Although, interestingly, about a third had actually reduced their plans in that district.
Okay.
So it shows that despite the overall trend towards caution and delayed hiring, some businesses were still sticking to their original staffing intentions. It highlights again that regional differences and firm-specific factors, maybe their individual outlook or financial health, are also very much at play. It's not one single story.
Okay, so summing up the labor market picture. Stable overall employment nationally, but with clear signs underneath: softening demand, lower turnover, more applicants. Hesitation to hire due to uncertainty is widespread. Some targeted layoffs are occurring in specific sectors, but hiring plans are actually holding steady for a noticeable number of firms, especially in certain regions.
Got it. Now, what about wages? That's the other side of the labor market coin. With labor demand softening, are wage pressures finally starting to ease up?
Well, nationally, the report states that wages continue to grow at a modest pace.
Modest pace. Okay. What does that mean exactly? Still going up, but maybe not as fast as before.
That's generally how it's interpreted, yes. It suggests some continued upward movement in compensation overall, but likely at a slower rate than we saw during those periods of peak labor market tightness when businesses were really scrambling for workers.
And is that modest pace of wage growth felt uniformly across the country, or are we seeing regional variation here too? I suspect I know the answer. Huh? Yes. As with most things in the Beige book, there is definitely nuance here. Many districts did report a general easing in wage pressures.
Okay, so aligning with the softening labor demand.
Exactly. That makes logical sense. When there's less intense competition for workers, the pressure on businesses to aggressively raise wages tends to decrease. However, The report also highlights an important counterpoint. A few districts indicated that the higher cost of living continued to put upward pressure on wages, regardless of the broader labor market dynamics.
Ah, that creates a fascinating tension, doesn't it? You've got maybe employers feeling less need to offer big raises because hiring is easier, but at the same time, employees might be feeling more need to ask for raises just to keep up with the rising costs of essentials like housing, food, and transportation.
Absolutely, it's a push and pull, and the source material explicitly mentions this dynamic. Contacts in both the Richmond and San Francisco districts specifically noted employees requesting wage increases because their cost of living had gone up.
Okay, so workers feeling the pinch.
Yes. And the St. Louis Fed also mentioned that recent minimum wage increases in their district were contributing to overall wage growth there as well. So policy plays a role too.
Were there any other specific examples given in the district reports that show how these wage dynamics were playing out differently?
Yes, there were some really illustrative examples. The New York Fed contacts observed that job switchers, people moving from one company to another, were no longer receiving those outsized pay increases that had become pretty common when the market was super tight.
Okay, the premium for switching jobs is shrinking.
Seems like it. The Philadelphia Fed reported an interesting contrast. While their non-manufacturing contacts reported that expectations for compensation costs had actually climbed, they were simultaneously seeing decreased wages being offered for entry-level, unskilled jobs, where labor supply was apparently more readily available.
Wow, so falling wages for some roles even as overall cost expectations rise.
Right. And conversely, the Cleveland Fed noted declining wage pressures for those entry-level roles, similar to Philly, but they saw sustained competition, keeping wages up for more skilled workers. Shows the importance of skill level.
Definitely.
The Minneapolis Fed reported moderate wage growth overall. They even gave a median year-over-year increase of about 3% among their contacts, but they noted stronger growth in sectors like tourism and accommodations compared to weaker growth in nonprofits. And construction unions in their district had secured wage increases over 4%, but simultaneously, some construction contractors were actually discounting their labor rates because construction activity had slowed down so much.
Gosh, those examples really underscore that a single phrase like modest wage growth nationally can hide a huge amount of variation, can it? It really depends on your industry, your skill level, your location, maybe even whether you're in a union or not.
Absolutely. It paints a much more complex picture than just a single national average.
Okay, that paints a very detailed picture of a labor market that's stable in the aggregate headcount, but clearly shifting underneath, with softening demand and really varied wage pressures depending on all those local factors and skill sets. Fascinating. Let's turn now to prices. That's another crucial area, obviously, for both businesses and consumers. The national summary of this Beige book states that prices have increased at a moderate pace since the previous report.
Okay, a moderate pace of increase. Now, what do the contacts tell the Fed about their expectations for prices going forward? Is this moderate pace expected to continue, or accelerate, or slow down?
This is where the report becomes particularly noteworthy, and it really points towards potential future shifts. There were widespread reports, again, that word widespread of contacts expecting costs and prices to rise at a faster rate going forward.
Faster. Okay, so an acceleration anticipated?
Yes. This expectation wasn't just limited to a few areas or industries. It was a sentiment reported broadly across the districts. And a few districts even described these anticipated cost increases in pretty strong terms, using words like strong, significant, or even substantial.
Wow. Why this widespread expectation for accelerating price increases? Was there a single dominant factor that contacts across the country were pointing to as the main driver behind this expected pickup in inflation?
Yes, there absolutely was. And it's highlighted as a critical unifying theme across all the district reports in the source material. Every single district report indicated that higher tariff rates were putting upward pressure on costs and prices.
Every single one. Tariffs again.
Every single one. This wasn't an isolated issue mentioned here or there. It was cited by contacts in every region as a key factor influencing their current cost structure and, importantly, their future pricing decisions and expectations.
Okay, that is really significant. If tariffs are showing up as a universally acknowledged factor pushing costs higher across the entire country, that's a major finding. How exactly are businesses responding to these higher costs, particularly the ones they're linking directly to tariffs? Are they just, absorbing them and taking a hit on profits, or are they finding ways to pass those costs on to their customers?
The report provides some absolutely fascinating detail on this, and it really illustrates the diverse range of strategies businesses are employing on the ground to cope. The source lists several common responses. The most straightforward one, as you'd expect, is simply increasing prices on the specific items that are directly affected by the higher tariffs.
Okay, direct pass-through on affected goods.
Right. But interestingly, some contacts also reported increasing prices on all items, not just the ones hit by tariffs.
Huh. Why would they do that?
Well, the report doesn't explicitly say why in every case, but you could imagine a couple of reasons. Maybe the tariff costs are so significant they're impacting the business's overall cost structure, not just specific products. Or perhaps some see it as an opportunity if costs are rising generally. Maybe they can raise prices more broadly under that umbrella and improve margins on unaffected goods too. The New York Fed actually cited a heavy construction equipment supplier who planned to raise prices on goods unaffected by tariffs, anticipating that they could enjoy some extra margin before tariffs eventually increase their costs on other inputs.
Wow, okay, so potential spillover effects or even opportunistic pricing in some cases. What else?
Another common response mentioned was reducing profit margins. This happens when businesses face those higher input costs but feel they cannot fully pass them on to their customers, maybe because of intense market competition or because they know their customers are very price sensitive right now. The New York Fed mentioned an upstate wood mill whose ability to raise prices was constrained by the market, significantly reducing their profit margins. Dallas contacts also expected squeezed profit margins.
So taking a hit to stay competitive or retain customers?
Seems like it. And then there was a really interesting category of responses, adding temporary fees or surcharges.
Temporary fees?
Yeah.
Like a tariff surcharge line item.
Exactly like that. This allows them to pass on the cost increase, but also signals to the customer that it might be temporary, maybe tied specifically to the tariff policy, and leaves open the possibility of removing that fee if the tariff situation changes without having to lower their base prices later.
That's a very tactical response, isn't it? Sounds like a way to communicate, hey, customer, this extra cost isn't really us, it's this policy, and maybe it won't last forever, rather than just baking it into the permanent price.
Precisely, and we saw examples of this. The Minneapolis Fed noted that some manufacturers in their district were adding surcharges. And one contact there had actually added a surcharge line to their invoices, but interestingly, wasn't actually using it yet. They were basically getting prepared for the possibility.
Wow, proactive preparation.
Yeah. The Atlanta Fed mentioned that firms were often passing costs through using flexible measures like surcharges. And the St. Louis Fed had a particularly striking example that really illustrates this. A manufacturer had modified their receipts to explicitly display a 7% increase in cost due to tariffs. It was a separate line item that they said could be easily removed if the tariffs were no longer in place.
Gosh, that St. Louis example is incredibly vivid. Talk about transparency. It shows how businesses aren't just reacting financially, but they're also actively thinking about how to communicate these policy-driven costs to their customers and maybe manage expectations about duration.
Absolutely. It highlights that communication strategy component. Now, what about the timing? If businesses do plan to pass these tariff-related costs on, when did the contacts expect that to happen? Was it immediate or more gradual?
For those contacts who indicated they did plan to pass along tariff-related costs through higher selling prices or fees, the general expectation reported was that they would do so within 3 months.
Within 3 months. Okay, so relatively soon after the report was compiled in late May.
Yes. This suggests that the upward pressure we're seeing reported on input costs due to tariffs might translate fairly quickly into higher selling prices for consumers and other businesses, potentially accelerating that moderate pace of price increases reported in May itself. The St. Louis Fed specifically noted their contacts planning to pass along costs expected to do so within that 3-month time frame.
Okay, so the moderate price increases reported in May might have been just the beginning, with potentially faster increases coming down the pipeline in the summer months, as these expected cost increases, largely driven by tariffs according to the contacts, are passed through. What did the report say about the difference, if any, between input costs, what businesses pay for their materials and supplies and their selling prices, what they actually charge their customers? Was there a gap?
Yes, there definitely seemed to be a gap, suggesting that squeeze on profit margins we talked about. The report notes that input costs were rising strongly or robustly in several districts. They specifically mentioned New York, Cleveland, Richmond, Minneapolis, and manufacturers in Dallas experiencing these strong input cost pressures.
Okay, strong input cost rises.
Right. Selling prices, however, were generally described as rising more moderately on a national level, While selling prices were up moderately in places like New York, though the report noted the pace there had eased somewhat, Philadelphia, Cleveland, and Richmond, the description suggests a gap between those strongly rising input costs and moderately rising selling prices.
Which implies?
It strongly implies that businesses were indeed absorbing at least some of that increased cost pressure, which lines perfectly with the reports of reduced profit margins. The Minneapolis Fed specifically noted that input price pressures had intensified in their district recently, and contacts in both Richmond and Cleveland explicitly expected their selling prices to increase at faster rates going forward, suggesting they anticipated closing that gap somewhat.
So margins were getting squeezed because input costs, fueled heavily by tariffs but also other factors, were jumping faster than businesses felt they could or were willing to raise their selling prices, at least up to that point in May. Beyond tariffs, what were some of those other non-tariff factors that contacts mentioned were pushing up their costs?
Several districts mentioned specific material costs rising. The Chicago Fed noted rising costs for steel and also electrical components. Cleveland specifically mentioned steel costs again. San Francisco contacts reported higher costs for construction materials like concrete, but also parts and equipment. They also mentioned rising costs for insurance and utilities.
Okay, so broad-based cost pressures beyond just tariffs.
Yeah, and there were also mentions of specific food costs, though sometimes with variation. For instance, the Cleveland Fed noted that egg costs had actually been declining recently, but the St. Louis Fed mentioned that recent outbreaks of avian flu were impacting both egg and chicken costs in their region. So specific commodity issues can also play a big role depending on the industry.
It truly is a granular look, isn't it? It captures all these different pressures hitting businesses' cost structures from various angles. Did contacts mention how consumers were reacting to the price increases they were already seeing? Were people just accepting them?
No, not necessarily just accepting them. Consumer price sensitivity was definitely mentioned as a factor in a few districts. The Philadelphia Fed noted increased price sensitivity among consumers, which, as we discussed, likely contributes to why some businesses feel they can't fully pass on all their higher costs.
Right, limits their pricing power.
Exactly. The Richmond Fed also reported consumers being price sensitive and actively opting for lower-priced alternatives whenever available. This sensitivity acts as a kind of natural check or brake on businesses' ability to raise prices too aggressively, even when their own costs are rising significantly.
And tying this whole price discussion back to that overarching theme, how did the uncertainty around tariffs specifically affect businesses' ability to set prices? Did the report touch on that?
Yes, it did. Both the New York and Dallas Fed reports specifically stated that the ongoing uncertainty about the tariff outlook, which products would be affected, what the rates would be, how long they would last, was making it very difficult for firms to set prices effectively.
How can you set a stable price if your costs might jump unpredictably?
Exactly. How do you determine a stable selling price for your product if you don't know definitively what your input costs are going to be in 6 months or a year? Or if you suspect the tariff policy itself might change unexpectedly again? This uncertainty adds yet another layer of complexity to the whole pricing strategy for businesses.
Yeah, it's not just the level of the tariff, but the lack of clarity around it.
Absolutely. And I think this whole section on prices, the tariff impact, and critically, those varied business responses we discussed, this is where the Beige book, qualitative nature, really shines. It gives us such concrete examples of how these macro-level policy changes actually manifest in day-to-day business decisions.
Like that St. Louis manufacturer with the tariff line on the receipt.
Exactly. Or the New York florist having to adjust flower varieties based on origin costs because of tariffs. Or the Atlanta retailers rushing to front-run inventory buildups. The Richmond manufacturer shutting down an entire export product line. The San Francisco contact noting that anticipated price increases weren't even rolled back once some tariffs were removed.
Right. That was a fascinating detail.
It really is.
Yeah.
These aren't just abstract economic ideas. They're real business strategies and tangible consequences happening on the ground right now, driven significantly by policy choices and the uncertainty surrounding them.
It's absolutely fascinating to see that level of specific detail, how a change in, say, tariff policy can ripple down to influence something as specific as what type of flowers a local florist decides to buy, or how a manufacturer chooses to print their invoices. It paints a much, much richer picture than just hearing a headline that says inflation remains moderate. Okay, we've covered the national summary and the key themes like the labor market shifts, the price dynamics driven by tariffs, and that pervasive uncertainty. Now let's use those detailed district reports to take a deeper dive into some specific sectors of the economy and see how these broader trends played out on the ground, really highlighting some of those compelling regional examples the report offers.
Sounds good. Let's start by looking at consumer spending more closely. We heard the national picture was mixed, but the district reports really show us just how varied that experience was regionally, and also depending on the type of spending.
Okay, so where do we explicitly see consumer spending reported as slowing down or declining in specific districts? Which areas were feeling the pinch?
Several districts reported slowdowns. The Boston Fed, for instance, reported that both retail and restaurant sales had slowed modestly in their region. Cleveland noted a general pullback by retailers. The Kansas City Fed saw a significant decline in retail spending, and they specifically pointed to weakness in discretionary items, things people want but don't necessarily need.
Okay, pulling back on non-essentials there.
Seems like it. Minneapolis reported that overall consumer spending fell modestly, with restaurants seeing slower activity and patrons apparently spending less per visit when they did go out.
Hmm.
San Francisco noted that retail sales had eased, with sluggish sales particularly noticeable in tourism-dependent areas. They attributed this to lower foot traffic and generally cautious spending behavior, although they did mention that essential retail like groceries and home centers remained steady.
All right, so definite signs of consumer caution and pullback in several parts of the country. But the national picture was mixed, so where did consumer spending hold steady or even increase, according to the reports?
Right, there were areas of strength too. New York reported that consumer spending had picked up modestly overall in their district, and this was driven partly by strong auto sales and also increased restaurant traffic, particularly in New York City.
Okay, NYC doing well.
Chicago also saw consumer spending increase modestly overall. They noted non-auto retail was up moderately, consumer staples sales were solid, lawn and garden spending was healthy, and light vehicle sales were robust. So fairly broad-based strength in Chicago.
Interesting contrast there.
Yeah. Richmond reported a slight increase in consumer spending, with most retailers in their district seeing steady to increasing sales. Atlanta was described as little changed overall, but they noted that interesting modest spike in durable sales, like automobiles, and contacts there specifically attributed this to consumers rushing to buy ahead of anticipated tariffs on those goods.
Ah, that front-running behavior again.
Exactly. Though they did expect overall spending to soften later on, St. Louis reported a truly mixed picture within their district. Recreation and hospitality saw a slight increase, but retail sales, especially for discretionary items, saw a slight decline. Auto sales were unchanged overall, though they noted high-end vehicles saw lower volume and were often purchased with cash, suggesting maybe some stress at lower price points.
Cash for high-end cars.
Yeah.
Interesting.
And Dallas also reported a mixed picture. They said sales had rebounded initially in the reporting period, but then declined, notably in May. Auto sales there dipped after strengthening in March, which, again, they suggested might be linked to that forward buying ahead of tariffs, pulling sales forward.
Gosh, it's really clear from those examples that the mixed national picture for consumer spending hides a lot of regional variation, doesn't it? And it seems heavily influenced by local economic conditions, maybe specific industry exposures in each region, and certainly by consumer reactions to policy expectations, especially around those tariffs.
Absolutely. The tariff effect on consumer timing seems quite pronounced in some areas.
Were there any specific mentions in the reports of how consumers were shifting their spending patterns or maybe what they were prioritizing differently in response to these pressures?
Yes, several districts noted specific shifts in consumer behavior that really point towards increased budget consciousness or changing priorities. Richmond contacts, for example, mentioned consumers actively opting for lower-priced alternatives whenever they were available.
Trading down.
Trading down, exactly. Cleveland contacts also noted customers trading down, specifically mentioning pulling back from larger, more expensive discretionary purchases. The Kansas City Fed reported a fascinating behavioral shift. Their contacts saw people apparently spending more time at home. This translated directly into increased sales for things like groceries and home maintenance supplies,
Okay, nesting.
while simultaneously hurting businesses like restaurants and hotels. So a clear shift in where the money was going. Richmond contacts contrasted the performance of budget hotels and quick-service restaurants. They were doing relatively better versus luxury options, which were reported to be struggling.
So a bifurcation based on price point.
Seems like it. And Atlanta noted that lower-income consumer confidence seemed to be slowing down leisure travel demand, while higher-income Americans maybe less concerned about costs or international uncertainty, were increasingly vacationing domestically instead of going abroad.
Wow, those details really paint a picture, don't they? They show how economic uncertainty and cost pressures directly influence everyday decisions about where and how people choose to spend their money. Did the reports happen to mention the impact of tourism specifically, international or domestic?
Yes, tourism was specifically mentioned as a factor in several districts and often in a negative light in this report. Multiple districts, Boston, New York, Philadelphia, and Minneapolis, all specifically mentioned a decline in Canadian tourists impacting their economies.
Ah, the Canadians staying home more.
Apparently so, according to contacts in those northern border districts. And New York, Atlanta, and San Francisco noted a decline in international visitors more broadly, not just from Canada. San Francisco directly linked sluggish retail sales in some areas to their dependence on tourism, which was down.
Okay, so tourism, especially international, was a weak spot.
Yeah.
What about the retailers themselves? Were they reporting any issues related to inventory or supply chains, maybe tied to these trade issues?
Yes, definitely. St. Louis contacts mentioned experiencing higher inventories of general merchandise, which likely resulted from weaker than expected sales.
Got it. Stuck with stock.
Atlanta noted that retailers were currently working through inventory they had previously acquired, and they anticipated a drop in their inventory levels once those tariff-driven price increases were fully enacted, suggesting maybe a pause in reordering. They also expressed concerns about receiving new inventory in a timely manner after that recent surge in imports added tariffs, basically worrying about port congestion and delays.
Right, the bullwhip effect, maybe.
Could be. Chicago contacts had similar concerns about timely inventory receipt following that tariff-related import surge. San Francisco mentioned some businesses actually facing insufficient inventory, which they attributed to supply chain disruptions stemming directly from recent trade policy changes. And Dallas reported scattered product delays and shipping issues that were affecting retailers in their district.
So it really shows how those trade policy changes and the tariff expectations aren't just about the final price to the consumer. They're also having these direct, tangible effects on retailers' operations, their inventory management, their supply chain reliability.
Exactly. It's disrupting the flow of goods for businesses trying to stock their shelves.
Given all this, the mixed sales, the cautious consumers, the inventory issues, what was the general outlook reported for consumer spending in the coming months?
Generally, it leaned towards cautious or even pessimistic, again, tied directly back to that prevailing uncertainty and the expectation of higher prices ahead. Richmond contacts, for instance, were concerned about declining consumer sentiment leading to slower activity. Cleveland expected a modest slowdown, explicitly citing trade policy uncertainty. Kansas City anticipated a decline in spending due specifically to higher expected prices and tightening household budgets.
Okay, affordability concerns there.
Yes. Both Boston and Atlanta expected sales to slow down and explicitly cited tariffs as a key factor weighing on the outlook. Dallas contacts anticipated that the higher tariffs, if they fully materialized, would have an extensive impact, leading to squeezed profit margins for retailers and ultimately decreased sales. San Francisco noted that cautious spending behavior was expected to continue. So overall, not a very optimistic outlook for the consumer sector in the near term, based on these reports.
Okay, a fairly sober outlook there. Let's shift gears now and look at real estate and construction. That's another sector that's usually very sensitive to economic conditions, interest rates, and uncertainty. We heard the national summary said residential real estate sales were mixed or little changed overall. Let's break that down.
Right. So starting with residential,
Sure.
where did districts report actual declines or slowdowns in home sales or construction?
Okay, slowdowns. The Boston Fed reported that residential home sales had dipped slightly, and they noted this was the second consecutive report showing a slight decline, so a potential trend there. Philadelphia noted that new home sales had declined moderately. Minneapolis saw lower residential real estate activity overall. The Kansas City Fed reported that single-family home building has slowed down and sales of existing homes had fallen. San Francisco saw its residential market weaken slightly overall, with construction activity slowing and sales reportedly shifting towards smaller, lower-priced homes, which they attributed directly to affordability constraints.
Okay, so affordability is a big driver of that shift. Where did districts report stability or even increases in residential sales? Were there bright spots?
There were. Philadelphia, interestingly, saw existing home sales tick up slightly, even as new home sales fell. Atlanta reported that home sales had risen slightly, and contacts there attributed this partly to mortgage rates having stabilized somewhat recently. St. Louis had unchanged sales levels compared to the previous report, but they did note that the number of listings, the inventory available, had increased.
More choice for buyers there,
Okay,
potentially.
maybe. The New York housing market saw activity pick up noticeably. They reported rising demand and even bidding wars resurfacing in upstate New York and the NYC suburbs. Sales were significantly up in the Hamptons, but that seemed driven by cash buyers at the very high end of the market. New York City itself saw record high prices, but inventory remained very tight there. And Cleveland contacts reported an interesting observation that prospective buyers seem to be increasingly accepting current mortgage rates, maybe realizing they weren't going down anytime soon.
So maybe less rate shock, more resignation.
Perhaps. That's one interpretation.
What were the key factors influencing the residential market, according to the contacts? Beyond just interest rates, what else was shaping things?
Uncertainty was definitely cited as a major factor, alongside interest rates. St. Louis mentioned both. Low inventory also remained a primary constraint on sales in many areas, although, as noted in St. Louis, inventory was increasing in some places. Boston reported inventory had increased substantially year over year. Kansas City also saw rising inventory, which they said led to slightly declining prices in their area, and demand softening despite builders offering incentives and facing more competition from existing homes for sale.
So inventory dynamics are shifting.
Seems like it. Boston mentioned experiencing buyer fatigue stemming from those previously limited inventories. Dallas cited affordability constraints, that pervasive uncertainty again, and general market volatility as dampening sentiment, and they also noted that inventory was rising in their district. San Francisco similarly highlighted affordability, high mortgage rates, and uncertainty as key factors constraining the market.
What about the builders themselves? Any specific challenges mentioned?
Yes, builders in the Richmond district noted the expensive regulatory red tape was a burden. They also specifically mentioned the uncertainty around tariffs on building materials and appliances was holding up some of their projects.
Tariffs hitting construction too.
Directly. Contacts in Philadelphia similarly mentioned that the inability to accurately price material inputs due to tariff uncertainty was delaying or holding up projects there as well. Atlanta contacts reported builders were pulling back on purchasing new lots for future development. Richmond even had reports of purchase cancellations on new homes specifically because of uncertainty among federal government workers about their jobs or future prospects. And contacts in Richmond also noted seeing some buyers who were pre-qualified for mortgages but were just waiting on the sidelines, hoping for rates to drop before they actually committed to buying.
Wow. So the residential market picture is really complex, isn't it? Still grappling with those longer-term issues of inventory levels and mortgage rates, but now also significantly impacted by this overlay of general uncertainty, specific regulatory hurdles, and very pointedly, the uncertainty and potential cost increases related to tariffs on essential building materials.
Absolutely, it's a tangled web. Now moving over to the other side of real estate. Commercial real estate and construction. What did the reports indicate was happening there? Still facing challenges, especially in office space.
Commercial real estate activity was definitely described as mixed across the country in this report. It was reported as flat overall in both the Boston and Minneapolis districts. New York saw activity improve slightly. It remained steady in Atlanta and Dallas. San Francisco, however, saw commercial activity slowing slightly. And Philadelphia noted a slight decline, specifically in non-residential construction.
Okay, mixed bag. What about leasing activity within commercial real estate? Any trends in office or industrial space?
Looking specifically at leasing, activity was mixed in Boston overall. However, office leasing did expand or pick up in key markets like Boston itself and Providence, and also notably in New York, specifically Manhattan, where vacancy rates were declining and leasing was strong.
Okay, some positive signs for office in big cities.
Yes, but maybe not everywhere. Industrial leasing, on the other hand, slowed or was stagnant in some areas, like Hartford, which is in the Boston Fed District, and it had leveled off after previous weakness in northern New Jersey, in the New York Fed District. However, Philadelphia saw an uptick in logistics and warehousing leasing. Chicago reported robust industrial demand. Atlanta noted elevated uncertainty was impacting the industrial sector, specifically due to tariff impacts. Dallas saw solid but slowing industrial demand, and San Francisco reported that commercial leasing demand overall fell, leading to more vacancies there. Contacts in Chicago also noted that demand for retail space was becoming increasingly dependent on location.
So, office space still facing challenges in some areas, but maybe seeing improvements in others, while industrial demand remains relatively strong overall, but is now also getting impacted by that same tariff uncertainty we're seeing everywhere else.
What about vacancy rates more generally?
Office vacancies remained high in Minneapolis, according to the report, although leasing was picking up somewhat. Contacts there did note, though, that larger tenants seem to be downsizing their office footprints. Richmond, however, saw its office vacancy rates decrease. Atlanta saw slight decreases in office vacancy, but interestingly, their industrial vacancies were up, which contacts attributed directly to tariff uncertainty impacting tenants' decisions. Minneapolis reported that industrial and retail vacancies were actually low in their district, but mainly due to a dearth of new development, not necessarily booming demand. Multifamily vacancy was expected to improve in Minneapolis as construction starts fall, while it was reported as stable in Atlanta.
Okay, a lot of moving parts in the commercial leasing market. What about commercial construction activity itself? Are people building new offices or warehouses? Commercial construction activity was described as flat or slowing nationally. It slowed modestly in Boston. It continued to decline in New York. It saw slight declines or was unchanged in non-residential categories in Philadelphia. Activity edged slightly lower in Minneapolis. San Francisco saw construction decline slightly.
What's holding it back? Costs. Uncertainty.
Both, it seems. Rising costs were explicitly mentioned as a constraint on commercial construction in Boston, and that theme of uncertainty was cited as causing cautious investment decisions in commercial real estate projects in Cleveland, Kansas City, and San Francisco. Contacts in Philadelphia, similar to the residential side, reported the projects were literally being held up due to the inability to accurately price material inputs and the general uncertainty related to tariffs,
So tariffs are delaying commercial projects too.
directly impacting timelines and feasibility, yes. New office construction was described as muted in Philadelphia, though they did note some continued activity in the education and medical sectors, as well as ongoing public infrastructure projects. Demand for multifamily construction remained high in some areas, like Boston and Atlanta, but contacts reported that new developments had slowed down due specifically to rising costs.
So very similar themes emerging here in commercial construction as we saw in residential. Rising costs, fueled at least partly by tariffs on materials, and that pervasive uncertainty causing delays and very cautious investment decisions, especially for large, new commercial projects.
Exactly. The parallels are quite clear.
Okay, let's move on now to manufacturing. This is a sector where the impact of trade policy and tariffs is often quite direct and visible. Nationally, the report said manufacturing activity declined slightly overall.
Right. Which specific districts reported declines in their manufacturing sectors? Where was the weakness concentrated?
Declines, sometimes slight, sometimes moderate, were reported by contacts in Boston, New York, Richmond, Chicago, St. Louis, Dallas, though Dallas noted the pace of decline had slowed, and San Francisco, where activity slowed slightly. So that's a majority of districts seeing some level of manufacturing contraction.
Okay, widespread weakness then. Were there any districts where manufacturing actually saw increases or stability? Any counterpoints?
A couple, yes. Philadelphia saw an uptick specifically in manufacturing jobs, although their report described overall manufacturing activity as being flat or having maybe modestly increased before declining again recently. So a bit of a mixed signal there. Minneapolis, however, did report that manufacturing activity in their district had increased moderately, so at least one district showing clear growth.
Okay. What seemed to be driving these changes? Was it mostly about demand and new orders?
Demand and new orders were definitely key factors mentioned. Boston and Cleveland saw demand slow down, specifically amidst the uncertainty and the tariff environment. Contacts in Cleveland, Chicago, and St. Louis all reported softer new orders. St. Louis also saw decreased production levels and lower capacity utilization as a result.
So less work coming in the door?
Pretty much. On a slightly brighter note, both New York and Philadelphia saw new orders and shipments pick up slightly after they had been declining in previous periods. However, the overall trend seemed negative as new orders decreased overall in St. Louis and Dallas. San Francisco reported that demand for final manufactured products had weakened, particularly after some pre-tariff spikes in buying had passed, and demand for intermediate goods had also softened. Minneapolis contacts had mixed sentiment on orders. They reported a net increase overall, but noted that a large share of their contacts were still seeing decreases. So again, variation even within districts.
Were manufacturers making specific operational changes in response to these conditions, especially regarding tariffs? We heard about pricing and inventory, but anything else? Yes, this is another area where the tariff impact becomes very tangible and forces real changes. The Richmond Fed reported a really striking example. A multinational machine manufacturer had actually shut down a domestic product line entirely. The reason. That line primarily sold internationally, and it was no longer viable due to tariffs on U.S. exports.
Wow, shutting down a whole line because of tariffs. That's
Yeah.
a major impact.
Huge. Another example from Richmond. A small food manufacturer laid off an employee specifically because of the uncertainty about their future input costs, much of which was tied to tariff concerns. And a furniture manufacturer in Richmond had reduced their workweek for employees due to slower business.
So, direct impacts on production and employment. What about sourcing and location?
Yes, there was definitely increased interest reported in reshoring or shifting production locations to navigate the tariffs. The New York Fed noted a producer of retail cooking supplies was actively ramping up production outside of China. They also mentioned receiving inquiries from their clients who were looking into reshoring their own manufacturing back to the U.S. to avoid tariffs.
Okay, so tariffs potentially driving some reshoring interest.
Potentially, yes. Cleveland contacts also mentioned customers seeking domestic substitutions for imported goods due to tariffs. Minneapolis saw interest in reshoring parts production specifically, and inventory adjustments remained a common strategy. Boston firms boosted inventories of foreign inputs ahead of anticipated tariffs. St. Louis manufacturers were reportedly overstocking finished goods. Kansas City saw a split, with about half of businesses increasing inventory while almost as many were actively running down their existing inventory. Dallas reported that about half of their manufacturing firms sourced inputs from outside the U.S., highlighting the broad exposure. Supply availability was also an issue, reportedly worsening in New York and expected to worsen further in Chicago, potentially due to those trade disruptions.
God, these are incredibly specific real-world examples, aren't they? They show how trade policy is directly influencing fundamental business operations, deciding which product lines to keep open, leading to layoffs, prompting shifts in where things are made globally, and forcing complex changes in inventory strategies. What was the overall outlook reported for the manufacturing sector?
Mhm.
Still pessimistic.
Generally, yes, often more pessimistic than other sectors, particularly in districts with heavy trade exposure. The Boston Fed reported a more pessimistic outlook among their manufacturers. They expected sales to slow due specifically to tariffs, but also mentioned concerns about federal funding cuts affecting the life sciences industry and just general consumer weakness feeding through. New York contacts were described as quite pessimistic.
Quite pessimistic. Strong words.
Very. In contrast, manufacturers in Philadelphia actually saw their expectations rise moderately, so a pocket of optimism there. Cleveland's outlook was described as flat. Dallas reported its manufacturing outlook had worsened further since the last report. Contacts there expected negative impacts from tariffs, leading to squeezed profit margins, lower capital spending, and ultimately a drop in production. Atlanta's manufacturing outlook was mostly negative, and contacts there specifically cited trade policy as their top concern for a potential recession.
Wow. Trade policy is the #1 recession risk.
According to those Atlanta contacts, yes. Kansas City manufacturers found that the tariff uncertainty made long-term planning extremely difficult, which prompted them to shift toward shorter planning cycles and hold higher precautionary inventories just in case. San Francisco's overall expectations for manufacturing were described as generally downtrodden, although they did note it was slightly more positive than the prior report period, so maybe bottoming out there. Hard to say.
The strong link between tariff concerns and a generally pessimistic outlook seems incredibly apparent in the manufacturing sector reports. Okay, related to manufacturing and trade, what about the ports and transportation sector, the sector that actually handles the physical flow of all these goods?
Right. Activity at ports was described as robust nationally in this report. The Richmond Fed, for instance, reported robust port volumes, and they noted a significant import surge, specifically attributed to businesses front-loading autos and parts ahead of anticipated tariffs.
There's that front loading again, showing up at the ports.
Exactly. Other transportation and warehouse activity, however, was described as mixed nationally. Atlanta saw modest growth in transportation overall, but Chicago reported that truck transportation demand had actually declined. St. Louis saw logistics activity increase slightly, which contacts there also attributed to stockpiling ahead of tariffs.
How were tariffs specifically impacting this sector beyond just changing the overall import and export volumes? Were there downstream effects?
Oh, absolutely. On the export side, volumes decreased due to retaliatory tariffs placed on U.S. agricultural products, which was noted by both Richmond and San Francisco.
Okay, exports down due to retaliation?
Richmond noted a fascinating detail. Bonded warehouse space near their ports was through the roof because shippers were holding cargo there, apparently waiting for more clarity on tariff policies before moving it inland.
Wow, warehouses full of waiting cargo.
Yeah. They also noted maritime bookings were down, freight rates were flat, and ocean carriers were reducing vessel capacity, possibly anticipating a slowdown after the surge. Contacts there expected import volumes to slow significantly after the recent front-loading rush. Interestingly, trucking demand was reported as weak near the ports, despite the surge in imports, which might be because so much cargo was being held up in those warehouses instead of being immediately trucked out.
That makes sense. Bottlenecks.
Seems like it.
Yeah.
An airport in the Richmond district had actually begun a warehouse expansion, specifically to accommodate this need for cargo staging near the port. Atlanta contacts expressed concerns about potential short-term capacity issues across the entire logistics, chain rail, warehousing, trucking, ships, and the ports themselves due to the massive import surge that was occurring amid a temporary tariff pause on certain goods from China. Kansas City reported increased global transportation costs stemming directly from businesses accelerating their import activity ahead of tariffs. This led to tight ocean shipping capacity, surge pricing from carriers, and even forced some businesses to use costly air freight to get their goods in time. And they intended to pass these higher shipping costs on to consumers over the next year.
Gosh, these examples really show how businesses reacting to policy uncertainty by rushing imports is physically straining the infrastructure of trade, don't they? It's filling up warehouses, creating bottlenecks at ports, driving up shipping costs through frantic demand surges. It's a real physical manifestation of the policy uncertainty.
Absolutely. The connections are very direct.
Okay, let's move on to the broad services sector, specifically non-financial services. How is that part of the economy faring?
This sector was described as mixed nationally, again reflecting that overall varied picture. The New York Fed District actually reported a moderate decline in services overall. They saw strong declines, particularly in leisure and hospitality, and also in information sectors, alongside moderate declines in business and personal services. So broad weakness in services in the NY Fed's region.
Okay, but other areas?
Richmond reported a slight increase in non-financial services activity. Dallas was described as flat or steady. And San Francisco saw activity in consumer and business services moderate somewhat, so quite a range of experiences.
Any specific examples within the services sector that stand out? What kinds of services were strong or weak?
Well, echoing that New York report, leisure and hospitality seemed to be a softer area in several places. Airlines in Dallas reported waning demand for leisure travel. Atlanta and San Francisco also noted subdued leisure travel, linking it to lower consumer confidence and maybe uncertainty. Business travel was also reported as down slightly in Atlanta and subdued in San Francisco, which contacts there tied to both general uncertainty and cuts in government spending impacting travel budgets. Group travel had dipped initially, but was reportedly recovering in Atlanta.
What about tourism specifically? We mentioned the international weakness earlier.
Right. Tourism activity was specifically described as flat in Boston and steady in New York City, but it declined modestly in Atlanta overall. It was slightly up in Philadelphia. Minneapolis saw lower tourist traffic and visitors spending less. And as we noted, multiple districts, Boston, New York, Philadelphia, Minneapolis, San Francisco, specifically blamed declines on fewer Canadian tourists crossing the border.
Okay, so leisure travel and tourism generally soft, with some exceptions. What about hotels?
Hotel occupancy was slightly higher in New York, partly due to graduation season, and New York City itself saw historic high room rates despite the broader service weakness there. Boston's occupancy dropped slightly year over year, but reportedly remained strong overall. Atlanta saw flat or slight rises in hotel occupancy, but noted hotels were offering increased incentives to attract guests. Broadway ticket sales, interestingly, remained solid in New York.
So maybe entertainment holding up better than travel? What about professional services?
That seemed to be a relative bright spot in some areas. Cleveland and Dallas both saw strong demand for professional and business services, like accounting or legal help. Contacts in those districts partly attributed this strength to regulatory changes that were requiring businesses to seek more consulting or legal assistance.
Ah, so regulation driving demand for some services.
Potentially, yes. However, Richmond noted that consulting firms in their district were generally reducing or maintaining staff levels due to uncertainty, suggesting maybe caution even where demand was okay.
Okay, what about overall demand for these non-financial services?
Richmond reported that demand had increased slightly overall, but contacts there were unsure how long that strength would last. Professional services were mixed in the St. Louis district. Architecture firms saw activity weakening. A Memphis firm's sales pipeline had diminished, but conversely, an Arkansas firm saw its sales exceed expectations. So again, very localized experiences. Marketing consulting inquiries were reportedly up in Richmond, San Francisco noted that while demand for services like medical testing, legal, and other professional services was stable, they were seeing clients increasingly switching to cheaper service packages where possible, indicating that cost sensitivity again.
So cost sensitivity is showing up in services too, not just retail. Clients are trading down even for things like legal or medical services if they can. Interesting.
It suggests budget pressures are pretty broad-based.
Okay, let's shift to banking and finance. How is activity in the financial sector described? Mixed again.
Mixed again nationally, yes. The New York Fed reported that banking activity in their district continued to decline modestly. St. Louis, however, reported banking activity was unchanged. San Francisco said financial services were stable. And Dallas actually saw overall loan volume grow slightly. So quite varied signals from different regions.
What about loan demand specifically? Were businesses and consumers looking to borrow more or less?
Loan demand was described as mixed or flat nationally. It reportedly weakened across the board for small to medium-sized banks in the New York district. It was flat in Cleveland. In Richmond, demand was steady for most loan types, though they saw a modest increase in commercial real estate, CRE, loan demand. Loan growth slowed in Atlanta. Loan demand increased slightly in St. Louis, but contacts said it was less than they had expected and seemed negatively affected by uncertainty. It was unchanged overall in Kansas City, though they saw a slight increase in commercial and industrial C&I loans. Loan demand was unchanged in Dallas. Consumer loan demand was unchanged on net, but varied by region within the San Francisco district. Business loan demand was generally subdued in San Francisco. Philadelphia saw C&I lending hold steady, auto lending grew modestly, residential mortgages and home equity lines increased slightly, while consumer lending and CRE lending saw slight declines. So really all over the map depending on the loan type and the region.
Definitely no single narrative there on loan demand. What about credit conditions? Were banks making it easier or harder to get loans? Tightening or loosening standards?
Again, a mixed picture here too. And this is where tariffs explicitly enter the financial picture. Credit standards reportedly continue to ease in New York. However, Atlanta reported tighter standards for commercial lending, and they specifically mentioned this was particularly true for industries they deemed to be exposed to tariffs.
Ah, so banks are looking at tariff exposure when deciding whether to lend.
Explicitly so, according to the Atlanta Fed's report. Dallas also reported that credit tightening continued in their district, while Kansas City saw unchanged standards. Other conditions varied too. Loan interest spreads narrowed in New York, and deposit rates were declining there. Deposit levels were stable in Richmond and Kansas City, slowed moderately in Atlanta, and saw slow growth in San Francisco. Philadelphia just noted the ability to attract deposits.
What about credit quality? Are existing loans being paid back? Any signs of stress?
Credit quality also presented a mixed picture. It reportedly improved in New York, with fewer delinquencies, notably for commercial mortgages. Credit quality was described as generally good in Philadelphia and Kansas City. But some districts saw modest increases in delinquencies or, importantly, expected future increases. Richmond saw modest increases. St. Louis contacts expected increases in both consumer and commercial delinquencies. Kansas City contacts also expected some deterioration in credit quality ahead. Loan non-performance continued to rise slightly in Dallas, although they noted it was at the slowest pace since late 2022. Dallas contacts also noted concerns regarding office and multifamily CRE loan performance, although they said those concerns seemed stable or slightly down from their peak, while performance on other types of CRE loans had ticked up. San Francisco reported rising credit card delinquencies and said they were experiencing some losses on CRE loans.
So some signs of stress emerging, particularly in consumer credit cards and CRE in certain areas. Any other financial market conditions mentioned?
The Chicago Fed reported that financial conditions had loosened slightly in their district, with bond values rising, equity values increasing sharply, and market volatility falling significantly during the reporting period. However, they noted acquisition financing had slowed down. Business loan quality had decreased slightly in Chicago, with office default specifically mentioned. Consumer loan demand, quality, and terms were flat in Chicago, though interest rates had decreased slightly. They also saw credit utilization increase, which contacts attributed partly to businesses purchasing inventory potentially related to that front-loading ahead of tariffs we keep seeing.
And did bankers mention uncertainty or tariffs impacting their activity?
Yes, directly. New York bankers noted that tariff uncertainty was putting some deal activity, like mergers and acquisitions, on hold. And a Cleveland banker explicitly mentioned that a potential borrower's tariff exposure was becoming a criterion they considered during the credit approval process.
Wow, that's a really clear illustration, isn't it? How that pervasive uncertainty and the specific issue of tariffs is filtering right down into the core functions of the financial sector. Tariff exposure actually being considered in whether or not to approve a loan in one district, that's a very concrete impact.
It absolutely is. It shows just how interconnected everything is. A policy decision on trade can directly influence credit availability for businesses. Richmond contacts also noted that borrowers themselves were moving forward cautiously when taking out loans, reflecting that broader hesitancy.
Okay. Finally, before we pull everything together, the Beige book also provides insights into community conditions. This gives us a look at the economic landscape beyond just businesses and financial markets, focusing more on nonprofits, social services, and maybe lower income households. What were the key findings there?
This section revealed some significant challenges, often linked back to government policy changes. A widespread and major theme reported across several districts, including New York, Atlanta, Chicago, Dallas, and San Francisco, was the negative impact of federal government funding cuts to various social programs.
Funding cuts hitting nonprofits.
Yes, widespread reports of financial pressures and distress for nonprofits and social service organizations directly due to these cuts.
What specific areas or types of services were being affected by these funding reductions?
The New York Fed noted these cuts extended into critical areas like healthcare access programs, housing assistance, and even arts and humanities organizations. Atlanta contacts reported that these funding reductions were directly threatening the ability of these organizations to meet the needs of their communities, and in some cases, even threatening their ability to continue operations at all.
Gosh, threatening closure?
That was the concern expressed. Nonprofits are reportedly taking action to try and shore up their finances in response. Things like implementing staff reductions, mentioned in Atlanta and San Francisco, or trying to build up financial reserves, Atlanta. These cuts are leading to hiring pauses or reductions in the actual provision of new services, mentioned in Cleveland, Atlanta, San Francisco. Cleveland specifically mentioned that government monies were being pulled from major brownfield remediation projects and other local infrastructure initiatives due to these cuts.
So, real impacts on local development and services.
Definitely. Chicago noted that the reduced federal funding was leading to increased competition among nonprofits for scarce private and philanthropic dollars. They also expressed specific concern about the potential impact on childcare services. Dallas and San Francisco reported that refugee and immigration services were being severely impacted by federal funding cuts. And funding instability, just the lack of predictability, was cited as a key concern for Dallas nonprofits for the foreseeable future.
So these funding cuts have very tangible and immediate consequences, it sounds like, particularly for vulnerable populations and the organizations trying to support them, as well as for local development efforts. Were tariffs and other rising costs impacting nonprofits as well, or just the funding cuts?
Both, it seems. The New York Fed specifically mentioned that nonprofits in their district were also facing higher material costs, some of which they attributed to tariffs. And Cleveland noted that the general uncertainty over inflation, plus the uncertainty about tariffs impacting building material costs, was actually stopping some planned affordable housing developments from moving forward.
Wow, tariffs potentially halting affordable housing projects.
That was a report from Cleveland Contacts, yes.
And what about the demand for these social services? With all the economic uncertainty we've been discussing, was demand for help increasing or decreasing?
Demand remained elevated, often increasing, even as the capacity to provide services was being constrained. Both Dallas and San Francisco reported elevated demand for social services in general. Dallas specifically noted an uptick in clients seeking basic necessities, particularly among low-income workers and recent immigrants. San Francisco saw individuals and households increasingly seeking assistance with fundamental needs like housing, healthcare, and food. So you have this difficult dynamic: higher demand for services coinciding with reduced capacity due to funding cuts and rising operational costs.
That's a tough situation for those communities. Were there any other notable community-level issues or challenges mentioned in the reports?
Dallas mentioned ongoing challenges with access to public transportation and affordable childcare, which they noted were impacting workforce participation for some residents. They also mentioned unresolved issues from previous flooding incidents, with recovery hampered by a lack of federal assistance. The Kansas City Fed reported specifically on Community Development Financial Institutions, or CDFIs, which often serve lower-income communities. They noted these CDFIs were tightening their lending standards, seeing increasing financial stress among their clients, worsening client credit scores, and seeing an increase in clients seeking debt consolidation services. They also expressed concerns about the prevalence of payday loans and student loan burdens in the communities they serve, as well as worries about the CDFI recertification process and challenges they faced in lending to other organizations that rely heavily on government contracts. San Francisco noted that the availability of affordable housing remained a major concern, and also that charitable donations to nonprofits had dropped recently. Yeah, this section on community conditions is a really powerful reminder, I think, that these broader economic trends, including specific policy decisions like funding levels or tariffs, have very direct and sometimes quite harsh impacts on the most vulnerable segments of our society and on the local organizations that are trying to provide a safety net or support. Cuts to federal funding directly translate into less support for basic needs, and rising costs, potentially exacerbated by tariffs, can halt crucial projects like affordable housing developments. It really grounds the whole economic discussion.
It absolutely does. It grounds it in the human reality behind the statistics. Okay, finally, before we try to synthesize all of this, let's briefly touch on agriculture and energy, sectors that are obviously crucial to certain districts' economies.
Right. In agriculture, conditions were generally described as mixed or weak in districts like Minneapolis and Kansas City. Low commodity prices were reported to be weighing heavily on farm income in both those districts. Weather was also a factor. Winter wheat conditions were poor in Nebraska, part of the Kansas City district. Wet soil and recent storms were delaying planting in some areas, reported in St. Louis, which was leading some farmers there to shift towards planting soybeans instead of corn, for example. Dallas, however, reported favorable planting conditions, but noted that timely rains were needed soon. Planting progress overall was actually ahead of or near typical levels in Minneapolis and Kansas City.
What about prices for farmers? Any bright spots?
A couple mentioned. Cattle prices were reportedly up, which was helping support profits for ranchers, noted in Kansas City and Dallas. And cotton prices were up, specifically linked to news related to tariffs, Dallas. However, grain prices were generally soft, Dallas. Uncertainty over the cost of inputs like feed ingredients and chemicals was noted as a concern in St. Louis. The Emergency Commodity Assistance Program was mentioned as providing some welcome relief to farmers in Kansas City and Dallas. Chicago contacts expressed concern about heavily leveraged farm operators potentially losing access to agricultural financing.
And tariffs, did they impact agriculture directly?
Yes, very directly on the export side. San Francisco reported that exports fell for specific products important to their region, like nuts, tree fruit, beef, and logs, due to retaliatory tariffs imposed by other countries. This forced producers to try and sell more on the domestic market, which often resulted in lower prices for them. They also noted a shift away from higher-priced specialty products like organic produce. Anticipated increases in input costs like fertilizer were also a concern noted in San Francisco. And some large crop and hog operators in the Chicago district were reportedly scaling back or even ceasing operations altogether. Overall, agricultural conditions were described as flat at weak levels in Minneapolis.
Okay, so a really complex picture for agriculture, heavily influenced by the usual suspects like weather and global commodity markets, but also input costs, and clearly the very direct impact of retaliatory tariffs hitting exports hard.
Definitely. Now, for energy, the Atlanta Fed District reported moderate growth in most energy sectors. They saw strong activity in LNG liquefied natural gas production, exports, and global demand. Domestic oil demand was steady, though global demand remained soft, according to Atlanta contacts. Utility demand varied by customer type. Residential demand was robust, commercial demand was modest, and industrial demand was slowing.
Any new opportunities or challenges mentioned?
Opportunities for growth related to data centers were noted in Atlanta, but they also saw some slight deceleration in that growth due to concerns about the rising cost of building the necessary infrastructure, potentially related to tariffs on imported components. Offshore wind development saw a significant decline in activity reported in the Atlanta district. Dallas reported that oil and gas activity had eased slightly, with the focus remaining heavily on the oil-rich Permian Basin. Exploration and production (E&P) firms there were reportedly cutting their capital expenditures more than they had originally planned for the year and expected nearly flat oil production through the end of the year. The Kansas City Fed saw power generation capacity grow moderately, particularly from wind and solar projects. Renewable energy investments were apparently carrying forward despite some energy policy changes, but rising equipment costs, supply chain uncertainty, and general energy policy uncertainty were putting marginal projects on hold.
So uncertainty hitting renewable projects too.
Yes, it led some firms there to focus on what they called no-regret investments, basically smaller projects with quicker payback periods, rather than committing to large, long-term ventures in the current uncertain climate. Rising retail electricity prices were also expected by contacts in Kansas City.
Okay, so the energy sector also seeing mixed trends. Some areas of growth like LNG exports and renewables capacity, but others facing pullbacks in investment or delays, again with rising equipment costs, potentially linked to tariffs, and broader policy uncertainty mentioned as contributing factors.
Absolutely. And I think looking across all these sectors we've just discussed, from consumer spending and real estate through manufacturing, services, banking, community conditions, and finally, agriculture and energy, we see how those key themes we identified at the national level really manifest differently on the ground, but they are undeniably present almost everywhere. Even in sectors or regions where overall activity is reported as stable or slightly growing, there are significant pockets of weakness being reported, distinct shifts in behavior occurring, and crucial impacts stemming directly from those two overarching themes we identified right at the top: elevated uncertainty and the direct and indirect effects of tariffs.
Okay, that was a really comprehensive tour through the districts and sectors. Let's try to pull all these threads together now. The key national takeaways from this deep dive into the May 2025 Beige book seem to be: first, an economy that slowed slightly overall, but with really significant variation bubbling underneath that average, regionally and sectorally.
Right. Second, a labor market that appears stable in terms of the total employment number, but is showing widespread signs of softening demand, lower turnover, more applicants, and very cautious hiring behavior driven by uncertainty.
And third, price pressures that continue to increase at a moderate pace in May. But with these widespread expectations among businesses for faster growth going forward, driven significantly, according to contacts across the board, by the impact of higher tariffs.
Exactly. And the district reports, with all those specific examples we discussed, they really reinforce and add that vital nuance to the national picture. They show us how that slight national decline translates into, say, hesitant consumer spending in places like Kansas City or Minneapolis. They show us what labor market softening actually looks like on the ground: lower employee turnover, more applicants being reported in many districts. And they show us how even modest wage growth is felt very differently depending on local costs of living or specific industry dynamics, like we saw with construction wages versus union contracts in Minneapolis.
And that pervasive uncertainty we talk about at the national level. The district reports make it crystal clear that it's not just some abstract economic concept. It's having concrete, real-world impacts across almost all sectors and regions.
Yeah, the examples were striking. It's delaying hiring decisions in districts from Boston all the way to San Francisco. It's causing businesses to pause capital spending plans in places like Cleveland, Kansas City, and Dallas. It's making long-term planning incredibly difficult for manufacturers.
It's affecting consumer decisions about what to buy, where to buy it, maybe even if to buy it. It's impacting commercial real estate deals. It's literally holding up construction projects because firms can't reliably price their materials due to tariff uncertainty.
And it's influencing banks' lending decisions, right down to the point where tariff exposure is becoming an actual credit approval criterion in at least one district. And as we just discussed, it's directly disrupting vital community services by freezing federal funding streams and halting local development projects. The reach is incredibly broad.
And the direct and indirect impacts of those tariffs, specifically that detail, reported universally across all 12 districts. The report shows just how widespread and complex those effects are.
Absolutely. We saw it causing rising input costs across almost every sector imaginable: manufacturing, construction materials, retailers' goods, even supplies for nonprofit organizations.
It's forcing businesses into this whole range of pass-through strategies, just raising prices on the affected items, maybe raising prices on all items, cutting into their own profit margins, adding those temporary surcharges, or just absorbing the costs for now.
Right. And it's prompting these strategic shifts in sourcing and supply chains. We heard about businesses actively exploring reshoring, ramping up production outside the U.S. specifically to avoid tariffs.
It's negatively affecting export volumes for certain products like agriculture due to retaliation, and it's boosting import volumes through that front-running behavior, which in turn is physically straining transportation and warehousing capacity and driving up shipping costs.
And it's influencing consumer spending patterns, increasing price sensitivity. It's affecting capital investment plans and construction costs. And as you mentioned, it's even raising specific concerns for financial institutions making lending decisions. It's hard to find a part of the economy not touched by this, according to the report.
It truly is remarkable when you lay it all out like that, how one set of policy actions, the tariffs and the uncertainty surrounding them, can ripple through the entire economy and have such a wide-ranging and incredibly complex set of consequences. And it often seems to be amplifying the effects of the more general economic uncertainty that was already present.
Yes, they seem to feed off each other. And the report implicitly highlights how these broad trends create specific areas of vulnerability within the economy. Contacts pointed to sectors heavily exposed to tariffs, like manufacturing and agriculture, as being particularly vulnerable. They highlighted nonprofits and community organizations that are heavily reliant on federal funding, especially given the cuts mentioned. They mentioned concerns about highly leveraged farmers facing low commodity prices and potential financing issues. And they pointed to consumers who are particularly sensitive to price increases or are already operating with tightening budgets as being especially exposed to the current environment.
So for you, our listener, what this deep dive into the Beige Book really provides is a level of detail and insight, that ground level texture that you simply don't get from just reading the headlines or looking at aggregate data. It shows us an economy that wasn't necessarily in a severe downturn back in May, but was undeniably operating under a significant cloud of caution.
Yeah, caution driven primarily by uncertainty, both the general economic uncertainty and very specific policy uncertainty, particularly around tariffs and federal funding levels. And we saw clear evidence that businesses, households, and community organizations were actively reacting to expected future changes right now in the present.
Whether that reaction was strategically buying ahead of anticipated tariffs, or delaying hiring decisions, or shifting supply chains, making cautious investment decisions, or tightening household budgets and nonprofit services, the anticipation of future policy was driving current behavior.
It powerfully illustrates how policy decisions, or sometimes even just the lack of clarity around future policy, can have these immediate and tangible effects on the real-world economy. It influences everything from a manufacturer's decision about where to produce their goods in a trucker's delivery route, all the way down to a nonprofit's ability to provide essential community services, and a family's decision about where to spend their limited grocery money. It truly brings that connection between the macro-level policy environment and the micro-level lived experience to life.
It really does provide a richness and a real-world context that aggregated data alone often misses. Hopefully, it serves as your shortcut to being truly well-informed about the actual texture and the underlying dynamics of the economy right now.
So just to quickly recap the key takeaways one last time from this deep dive into the May 2025 Beige Book. We saw an economy that had slowed slightly at the national level, but with really significant variation happening regionally and across different sectors. We saw a labor market showing widespread signs of softening demand, things like lower turnover, more applicants despite little change in the overall employment numbers, alongside very cautious hiring behavior. And we saw price pressures continuing, driven significantly by tariffs, which were forcing businesses into a whole range of complex response strategies, with widespread expectations that price increases would actually accelerate in the near future.
And the dominant thread weaving through all of it, the word we kept coming back to, was that pervasive uncertainty, economic and policy uncertainty impacting decisions across the board, from the smallest businesses to the largest corporations, from individual households to community organizations.
This detailed report, drawn directly from those contacts on the ground, provides that richness and real-world context we mentioned. It helps you understand not just what is happening in the economy, but maybe more importantly, why it's happening. Seeing the motivations, the challenges, the strategies that businesses and individuals are facing in real time.
Okay, as we wrap up this deep dive, let's leave you with a final thought to consider, one that's directly prompted by the findings of this May 2025 Beige Book. This report has really powerfully emphasized the real-world impact of policy uncertainty, whether we're talking about tariffs or federal funding cuts or regulatory changes on concrete decisions like business investment, hiring plans, consumer behavior, and even community well-being. It really raises the question, as you look at economic news yourself or as you make your own personal or professional decisions, how much are you seeing the effects of this kind of policy uncertainty influencing things in your own life or your work?
And maybe building on that, based on what we've heard from all these contacts across the country who are feeling hesitant and cautious, what do you think it might take? Perhaps more clarity or stability or some kind of resolution on some of these key policy fronts. What might it take for the economy to potentially, as one optimistic contact in the Boston Fed report put it, unlock, and for some of that pervasive hesitancy we saw in this report to finally lift?
Something to ponder as you continue to observe the economic landscape around you. Thanks for joining us for this deep dive.